Welcome to another CSEC economics lesson. For this lesson, we will focus on some national income accounting statistics. We want to look at the differences among national output, real output, and also potential output. So when we talk about output, we are talking about gross domestic product or GDP. And GDP refers to the market value of all final goods and services produced within a country in a given time period. Now, the GDP can be viewed in terms of it being a nominal value or a real value. So the nominal value is the value of all the final goods and services that an economy can produce during a given year. It is calculated by using the prices that are current in the year in which the output is produced. So when we're looking at GDP as a nominal value, we're looking at the year in which the goods are produced and the price that the goods are being sold. So for example, we might be looking at GDP in the year 2019 and the country is producing water bottles. And the price of water bottles in 2019, the year that the water bottles are produced, is $10 and the country produces 10 water bottles. If the price increases to $20 the following year, and we would have calculated the GDP in 2019 as $10 times 10 water bottles, that would have been $100 for GDP. If the following year we are looking at the bottles at a price of $20 and we still produce the same 10 water bottles, the GDP is considered to be the $20 multiplied by the 10 units. So the nominal GDP would be $200. The nominal GDP is based on the price in the current year and the quantity produced in the current year. That's a nominal value. It doesn't remove the effect of the price change or the inflation. Real GDP accounts for inflation by calculating the GDP based on a base year price. So it uses a base year price. So in the example I gave before, I gave 2 years, 2019 and 2020. And I said in 2019, the water bottles produced was for $10 and the quantity produced was also $10. So the nominal GDP and the real GDP for 2019 is $10. 2019 is $10. If it is that I consider the base year in this example to be 2019, even when I'm calculating GDP in 2020, when I'm calculating real GDP, I would use the price of the base year. That's how you calculate real GDP. So I am not taking into account that, okay, the country has improved in terms of its production or productivity because the value in 2020 is higher than 2019. It wouldn't be an accurate depiction of the production level since in both years the same quantity was produced. The only difference is that in the second year, the price of the good actually increased. So again, remember, real GDP is not influenced by changes in price. It's only influenced by changes in quantity. That's real GDP. So if we are trying to calculate real GDP, we can use the base year prices, or we can also use a formula. If you have nominal GDP and the figure for the GDP deflator, then you can divide nominal GDP by the GDP deflator and you'll get real GDP. Now, what is this GDP deflator that I just mentioned? Now, the GDP deflator is a measure of the level of prices of all new domestically produced final goods and services in an economy. It is a price index. It measures the price inflation or deflation and is calculated using nominal GDP and real GDP. So if you want to know the GDP deflator, you will need nominal GDP and real GDP. The GDP deflator is calculated by dividing nominal GDP by real GDP and multiplying it by 100. And the deflator is always 100 in the base year. When you subtract 100 from the deflator, the difference in value represents the percentage increase in prices or inflation level. Another concept for us to look at is the potential output. So potential output is the maximum amount of goods and services an economy can produce or would produce when operating efficiently. So if the economy uses all of its resources to its maximum capacity, then that is considered to be, or that level of output is considered to be the potential output. Now in this scenario, the economy is producing two goods, pencils and erasers. And the prices are there for each year of production. So notice the price increases each year for both goods, and also the quantity increases as well. So if we are calculating the real and nominal GDP for 2018, we'll notice that the figures will be the same. We'll multiply the price and quantity of erasers and the price and quantity of pencils, and we'll add both values together to get nominal GDP. And since it's the base year, it will also be the same for real GDP, which means that the deflator is going to be 100. In 2019, if 2018 is considered to be the base year, we notice the price increase in 2019 for both goods, and we notice that there's also an increase in quantity. So we want to look at the real GDP. We want to understand what GDP is, but we want to remove the effect of the price change. So we will multiply the quantities produced in 2019 by the prices that were used in 2018, because 2018 is the base year. So what we will get for the real GDP would be 35,000. But for nominal GDP, we'll use the price of the year that the goods was produced. So 20 times 1500 plus 30 multiplied by 1000. This will give us the figure for our nominal GDP. But for real GDP, we'll use the base year prices. And so, for us to know the percentage change in price, or if we want to calculate the GDP deflator, we'll divide the nominal GDP by the real GDP and multiply it by 100. So, the GDP deflator is 171. And if we subtract 100 from this, we'll get 71. So there was a 71% price increase. If we want to calculate the real and nominal GDP for 2020, we'll do the same thing that we did in the previous example. For real GDP, we'll use the base year prices, which are the prices of 2018. And for nominal GDP, we'll use the prices of the year that the goods were produced. So we'll use 30 multiplied by 2,000 and $40 multiplied by 1,500. We'll add both sums together to get the nominal GDP for 2020. But when we want the real GDP, we'll multiply the quantities produced in 2020 by the prices of 2018, and we'll add those two together. And so for nominal GDP, you should get 120,000. And for real GDP, you should get 50,000. And for the deflator, you should calculate 120,000 divided by 50,000, and the product will be 240 if you subtract 100 from that. you will notice that there's a 140% increase in prices. So, thank you for paying attention in this lesson. Make sure that you use some of these examples to help you in your practice.